All right, looking a little down for a Friday, but it is Friday. 30 minutes till the start of the cash trade. I'm Matt Miller.
And I'm Dani Berger. Bloomberg Open Interest starts right now.
Happy the world's richest person could become the first trillionaire ever after Tesla shareholders approved the biggest pay package in the history of the universe.
And AI enthusiasm increasingly meets skepticism. A volatile week ends with sparse eco data and a mixed earnings picture.
Plus, not so friendly skies. Airlines across the U.S. have started canceling flights as the government shutdown drags on.
Well, I'm happy I made it back to New York, so that's good news. I am here. But some of the travel stocks, Matt, have done really, really well over the past 12 hours after they reported earnings. Two of them I have for you on a board over here. Expedia and Airbnb reported after the bell yesterday, both delivering a positive outlook, basically saying travel trends are continuing. There's momentum into the holiday quarter, and Expedia saying no impact that they've seen from the government shutdown.
I am happy you made it back.
Thank you,
as
Matt.
Well, but not as happy as Elon Musk. He was dancing with robots. His $1 trillion pay package was overwhelmingly approved by shareholders in the company, paving the way for him to boost his stake in Tesla to at least 25% over the next decade, if he makes it worth $8.5 trillion. So he has to add like an Nvidia and a half to get there.
And he has to build his robot army in order to get there, too. Well, Dan Ives of Wedbush spoke earlier about the pay package on surveillance.
From a physical AI perspective, the two most important companies in the world, it's Nvidia and it's Tesla. And that's why this was important, because Musk is ultimately really going to be the key driver to get there. And I think investors recognize that 75% was a huge vote of confidence. And I think basically saying, like, you're our leader, lead us there.
For more, we're joined by Bloomberg Tech co-host Ed Ludlow. So, Ed, Elon got what he wanted and danced with the robots.
He did, and to Dan Ives' point, more than 75% of the vote was in favor of the compensation package, so it was overwhelming. But one must also take into account that Elon Musk, who is already the single biggest shareholder, was able to vote on his shares, as were the other board members. And I think at the time, that's about 16%. So take that into account. But for many weeks, we've been focused on the $1 trillion of compensation. For Musk, this was about voting power and control. And if you look at the institutional investors in particular that had voted no, for them, the dilution factor and the key man risk element was what they took issue with within the package. And Matt quite rightly points out that these are mandatory and very real operational and financial milestones that he has to achieve to get that, not just compensation, but the voting power as well. And as you see him dancing on stage, what happened next? He then went to do what Musk always does. He gave us some information about what Tesla plans to do near term to keep investors looking to the horizon.
I mean, to me, it makes sense that every owner of the company should be able to vote his or her decision on this. And if the owners of the company overwhelmingly agree to pay the CEO that much, they should be able to, especially since they'll all be very rich if he achieves these goals, right? I mean, he needs to add, what, $7 trillion in value to get the full package?
Exactly so, but it doesn't reconcile the key man risk element. So I think, would there be outsized performance and return to shareholders if Musk realizes all 12 tranches? Yes, of course, like the jump to $8.5 trillion. But the skepticism and concern among some of the investor base was like, if Elon Musk and the board already have 16% of the company anyway and that kind of voting power, and Musk takes his own individual stake to 25%, what then happens if something goes wrong?
Right.
And Musk chases after the compensation. He does go after the money. There's an element of worry there. But yeah, the mandatory milestones are worth recounting, be they the classic core business of delivering vehicles, Optimus robots, or the robotaxi targets that have been set.
Right. And also, only a small fraction of the owners of the company have that skepticism and concern, right? Like, clearly,
True.
Most of the people who own this company want this to happen. So I guess good luck and Godspeed. Ed, I'm sure you're going to cover this a lot on your program as well. Bloomberg Tech's Ed Ludlow, his show kicks off at 11 a.m., so it'll be an extra special Friday edition on today's Bloomberg Tech. The impact of the longest government shutdown in U.S. history hits travel. The FAA is cutting flight capacity by 10% to alleviate pressure on air traffic controllers. About 700 flights have already been canceled for today by the 4 largest U.S. airlines. Joining us now from Newark Airport is Bloomberg's Nora Melinda. And Nora, I mean, what kind of problems can you already see there? Or are things running smoothly because we've known this was going to happen for days?
Well, Matt, as you mentioned, we have known that this was going to happen for days here. We've been here for a couple hours at EWR Airport, and we are still seeing droves of people coming in. But as we're reporting on the ground, it seems that this is not uncommon. I mean, it's a Friday morning, and we are still seeing a lot of activity, a lot of travelers coming through here. But as you mentioned, a lot of delays here in focus. About 3% of all U.S. flights are canceled here in the United States. And this, of course, according to data that we got from an aviation analytics company, Cirium. So this, of course, is not as big of a number as you would expect. So, of course, we do have those government shutdown concerns and the implications here for travel. But if you put this in the grand scheme of things, 3% of all cancellations in the United States is a little bit lower than the 4 or 5% that we would see when you think about the likes of like a winter storm.
And Nora, what we've seen so far from some of the travel companies today, Expedia being one of them, saying we've seen no discernible impact from a government shutdown. Does that change for corporate America, for these travel bookers, for the airlines, if this drags on and more flights are canceled?
Well, we've been getting a lot of questions here about the impact on the bottom lines here for a lot of these airlines. And of course, the data is still really preliminary here, so we don't know the expected impact here in terms of the bottom line for these airlines. But we are seeing some notes and data coming in from TD Cowen. They're saying that this should be manageable for the airlines here, and they actually see this as an opportunity to potentially buy airline stocks. Dani.
All right, Nora, thank you very much. Bloomberg's Nora Melinda there at Newark Airport, keeping an eye on what so far looks calm there, but I guess could very well divulge into chaos.
Did you come into Newark yesterday?
No, I didn't. I specifically did not book Newark because I was scared to.
Smart.
Yeah, I had a flight last weekend coming into Newark that was canceled. Wasn't going to make that mistake again.
Yeah.
Now, so airline stocks are taking a hit, but as we were saying, the travel stocks are doing well today, specifically Airbnb and Expedia. They had strong quarters. Airbnb got a boost from its Book Now, Pay Later program. Expedia raised its full-year outlook as well. Joining us for more is Bloomberg Intelligence Global Head of Tech Research, Mandeep Singh. Mandeep, it's a choose-your-own-adventure economy. These travel stocks seem to be saying people are using us, booking us, and everything is good.
Yes, and look, when it comes to Airbnb specifically, the concern was, they are in a saturated market and they have to do something about expanding their marketplace. So, the fact that Brian Chesky said they're going to be launching one new business every year, and he seems to be quite optimistic about applying AI to change the marketplace, to really drive new ways of bookings. I think that's what kind of showed up in the stock reaction. But look, the numbers, kind of consensus expectations were low, so I don't think high single digit is anything to be really excited about.
Airbnb, Expedia, these are companies that Dani and I wouldn't expect you to cover. I mean, I know you're running the tech coverage for Bloomberg Intelligence, but we think of you as the AI guy, as the chips guy, Mandeep. Are these companies using AI? Are they able to boost productivity with AI? Are they able to improve the customer experience with AI?
Actually, you're right. So a lot of emphasis on the call yesterday was on how AI will change the travel booking experience, and really when it comes to search. In fact, they were asked why have they not partnered with OpenAI, because Booking and Expedia, the two other big OTAs, have partnered with OpenAI in terms of instant booking through the chatbot. And they said they are open to the idea of doing it, but clearly they don't want to get commoditized and be that data layer. So AI will have an impact in terms of search for travel and how you book your travel. It's just too early to kind of exactly imagine how those changes are going to flow through.
All right, Mandeep, thanks very much. Mandeep Singh there, who, as I said, runs our tech coverage for Bloomberg Intelligence. You can find his work if you type, I guess now you can just type ABNB, equity, BICO, go. Check on futures ahead of the open. After a down day yesterday, we're off again today. S&P futures down about 0.4%. The NASDAQ off a little bit more as the big tech companies that tend to move the market are a much heavier weight on that index.
Yeah, the NASDAQ on track for its worst week since the April Liberation Day sell-off. Some of the single stocks that we were watching this morning. Six Flags cut its outlook for a second time this year and took a $1.5 billion charge on its third quarter results after overestimating the performance of its parks. So no one going to Six Flags.
Even though everyone goes to Disney, that's so weird.
Very different offering.
I guess. Take-Two dropping after the video game publisher delayed the release of its much-anticipated Grand Theft Auto 6. Again, they continue to delay this, and this game is like 20 years old. I can't believe people still care.
It's going to be so expensive. They're going to now launch it in November of next year. DraftKings should also mention they're slumping after cutting its revenue forecast for the year. And DraftKings CEO Jason Robbins will be joining Bloomberg Tech. That is at 11:30 a.m. New York time.
Coming up, Wendy's posts better than expected earnings, signals the fast food chain is overcoming its slump as a lot of the fast casual guys are having problems. We'll give you the details next. This is Bloomberg Open Interest. Getting out of high interest, look what's making headlines around the world. Elise Stefanik has announced she is running against Kathy Hochul for the position of governor of New York. The 41-year-old representative for New York's 21st congressional district has become one of President Trump's most prominent allies in Congress. She rose to national fame for grilling the presidents of Ivy League universities about campus unrest and anti-Semitism. And Nomura ditches its efforts to restart a prop trading desk in London after less than 2 years. Sources say the bank ultimately decided to fold the fledgling prop desk into other parts of the markets business. Nomura spokesperson says the primary focus remains growing our diversified client franchise. And KKR reported its best fundraising quarter in more than 4 years, driven by record demand for its credit products. The buyout firm gathered $43 billion during the quarter, including $27 billion for credit alone. Alternative asset managers have been grappling with a difficult fundraising climate since the Fed began raising interest rates in 2022, though that seems, Dani, to have changed a little bit lately.
Yeah, that's changed. And I should also say that defies the whole doom and gloom about credit. They're fundraising clearly very well in that division.
I mean, credit's awesome. $6 trillion in bond issuance this year already.
A record. It's been wild. By the way, let's check on some earnings movers because Wendy's, that is up almost 10%, 9.4%. So their sales declined less than expected. They've been struggling. So is this the rebound for the fast food chain? Joining us now is Bloomberg consumer reporter Red Brown. Red, the flavor it feels like from earnings is that fast casual is suffering, but fast food is doing well. Is that a fair read?
No, I definitely think that's the best way to summarize the results we've gotten over the last week. It definitely seems like people are avoiding those like $15, $20 salad or food bowls when they can. And it does seem like that has a trickle-down benefit to a lot of the fast food companies who have made really strong strides to readjust their value proposition, right? We've seen Burger King, we've seen McDonald's make these moves to expand their value offerings to make sure that they say, like, look, if you are struggling right now and you want to have a nice meal, McDonald's or Burger King is a place you can do it. But at the same time, places like Sweetgreen, Kava are not able to make that same move, and that's why they're struggling.
Wendy's stock, though, has done horribly over the past 5 years. And I'm from the great state of Ohio, so I'm a Dave Thomas champion, of course. But it's down here, look, 46%. And meanwhile, McDonald's is up that amount. Why is Wendy's doing so badly compared to the Big Mac maker?
So there's a little bit of like a difference in strategy with these two. Like I think you're right. Like Wendy's does try to position itself as like the most premium of the fast food. So like they're almost kind of in this quasi gray area. It is really good, right? I mean they can back it up.
But you don't regret it as much after as you do other fast food.
I guess it depends on what time of the day it is.
Right.
But they are like this like gray area, I guess, a little bit between these two like sectors we were just talking about. So they have been kind of just trying to stick to their price a little bit more, saying we are a premium product, and they can't move the prices down too much, just considering where cost inflation is. And at the same time, McDonald's has the scale to take on some of these higher price points. Because they're able to negotiate better contracts with their beef providers, things like that. So
here's the comparison, by the way. Joe just pulled it up, the 5 years. So McDonald's there in yellow, Wendy's in white. It's rough.
Yeah, and I mean, Wendy's is making efforts to kind of halt the slide. They are doing things, they're like slowing down their new builds, things like that, so they can reinvest into the restaurants and hopefully spark a little bit more foot traffic.
There's no way you don't feel regret after eating a fast food chili situation.
No, the chili is delicious. I'm telling you. You crumble up crackers and put it in there, have it with a small Frosty. A small Frosty, because I'm watching my weight.
Like a bowl of regret, but that's okay.
Red, thank you very much. You've done an excellent job covering these restaurants. The fast casual crash and the fast food success. Red Brown covers earnings for us over at Bloomberg News. Coming up, it's been a week of sparse economic data and a mixed bag of earnings results. BlackRock's Rick Rieder joins us next because usually he comes to us on a Fed day, and this would be, a jobs day, and this would be a jobs day. So we're still happy to have him, and we'll talk about Bink as well. This is Open Interest.
Data and earnings are painting a mixed picture of the economy. ISM services, ADP employment, they come in solid. Challenger job cuts, those jump to one of the worst Octobers on record, ruining these markets, or the rally yesterday. Let's try to get a sense of direction. Bringing us that now is Rick Rieder, Chief Investment Officer of Global Fixed Income at BlackRock. And Rick, we always have you on a jobs day, and today is decidedly a jobs day that should have been. Are you just flying blind? This data, it depends what you look at. You can say the economy is great or things are falling apart.
It's funny. Thanks for having me on, by the way. It's a funny thing. I found that the industry's obsession with these individual days, and by the way, the payroll report's a great economic indicator. The CPI report, there is so much information that comes through the system. By the way, my favorite, I read tons, maybe too many, corporate earnings reports, and I look at what's happening with hiring, inventory management, receivables, et cetera. So there's still, would I rather have the data? For sure. By the way, I think the markets become hamstrung, and I think part of why the markets are acting in this sort of paranoid, what do people know, what's the information out there, manner today. I think I feel pretty good about knowing the structural direction of travel. I think the economy's in good shape. There are parts of it, it's not operating on all its cylinders, which we'll talk about. CapEx is great, high income is doing well, low income in the consumer side, not so much. But I feel pretty good about understanding. And listen, I think we have a softening of the labor market that is quite significant. And you see that, as you mentioned, the Challenger jobs report, you see that playing out. You certainly see that when I look at all the corporate earnings in terms of that. We have a softening labor market. And if we had the number today, I think it would have been reflective thereof.
Yeah, on flying blind, I couldn't agree with you more, and no one cares what I think, but Bob Michael of JP Morgan has made this point. Rich Clarida, former vice chair of the Fed, confirmed they have like 500 economists. They have 12 regional banks. They're talking to participants, to companies, to institutions every single day, so they have a pretty good handle on the economy even without it. I wonder about what you guys have at BlackRock. You have $10 trillion of assets under management, right? What kind of signals are you looking at? What kind of proprietary information are you getting that helps you in your job, Rick?
Matt, it's a great question. By the way, this morning we went through credit card data. So it's all available information. So we had a gentleman named Randy Berkowitz who drives every day. We look at what's happening in terms of, you go through the internet, you splice some of the credit card data that comes out. You get an amazing amount of high frequency data. So we'll use that. We use a series of data assimilation tools. By the way, text mining to understand what companies are saying. So anyway, we're trying, and by the way, we don't have it figured out yet, but we're trying to be pretty cutting edge around the amount of tools we use and how AI is helping us. By the way, also in things like how do you think about scenario analysis? How do you think about, the first derivative rate of change on inflation and growth? So listen, I think part of the why it's most exciting times for investing ever is the amount of tools you can utilize that allow you to get more verse around what the direction of travel in is pretty intense today. So, you know, we're still working and trying to figure out more tools we could use, but it's so much different, Matt, than quite frankly 5 years ago, 10 years ago.
Rick, I would be very interested to know if any of that data, any of the tools that you've been using and looked at, have changed some of your allocations or how you're thinking about Bink right now.
So it's a great question. Thanks for asking. I mean, so Bink, you know, there was something that is, I think, pretty intense around. So Bink, you know, has had a good run. We feel good about where it's going, and more people coming into it. The thing that it's allowed us to think through is today you've obviously got the way the Fed's going to interpret the data, which is not always what I agree with, but the Fed's going to interpret the data is you've got inflation that's a little sticky high, and then the employment that's moderating. So we think you're in this, and by the way, not just the Fed, the ECB, the Bank of England, the RBA, they're in this point of let's sit back and watch the data. So the way we move our positions around is we've reduced a little bit of our interest rate sensitivity. We pulled some of our interest rate sensitivity out of the front end of the yield curve and say, gosh, let's just get carry. We can reduce a little bit of our duration. We've reduced a little bit of our investment grade, more than a little bit of our investment grade credit, because quite frankly, today where spreads are, it doesn't do a lot for us. And if rates are pretty stable, agency mortgages become much more interesting, and low coupon agency mortgages become much more interesting in the portfolio. So we've been doing that. By the way, we look at the data, including last night. You're seeing with the mortgage rate coming down a bit of prepayment, faster prepayment. So we've reduced some high coupon mortgages. I know a lot of technical there, but some stuff moving around.
We should point out for viewers who don't know, Bink is the iShares Flexible Income ETF that Rick runs at BlackRock. Rick is going to stay with us through the opening bell into the equities trade next. This is Bloomberg. Moments away from the start of trading, this is Bloomberg Open Interest. I'm Matt Miller, and we're looking at a down day. After a down day, it's been a pretty volatile week. I think we've had 2 sessions this week where stocks have moved, in fact, to the downside more than 1%. So maybe you're getting a little bit of concern about valuations. You can see S&P futures down 1/3%, NASDAQ futures down 0.5%. That has been the talking point this week, although retail investors typically like to buy the dip. No matter what. You're getting, Pencil ringing the opening bell at the New York Stock Exchange. I have no idea what it is, but she is holding a Faber-Castell #2, as you can see right there. Down at the NASDAQ, there's a SPAC ringing the opening bell. If you're worried about froth in the markets, let me tell you, SPACs are back. And meme stocks.
We're so back, Matt.
Doing deals without bankers. Who needs lawyers?
Who needs them?
Yeah.
You don't need them.
Just get it done.
Deal. As long as you say something AI, you're off to the races, and your debt will do fantastically in the market. I am, of course, exaggerating.
Facetious.
There's been I'm being facetious. There's been some real questioning, especially in recent days, about that trade. But where we are not seeing questions asked, we are buying now. Are these travel stocks, Expedia and Airbnb, doing really well today? They both delivered a positive outlook. They signaled that travel trends are strong, that it's going to continue into the holiday quarter. And so far, Matt, they see no discernible impact from the government shutdown.
It's pretty impressive, especially on a day like today when we start to see those flights getting cut. Elon Musk's $1 trillion pay package was overwhelmingly approved by Tesla shareholders. That paves the way for him to boost his stake in the company to at least 25% over the next decade. He does, however, in order to do that, have to boost the value of the company to $8.5 trillion, which means adding another $7 trillion. And just as a reminder, there is no company worth $7 trillion. It would be a pretty amazing feat, I think. Having said that, inflation still seems to be way above the Fed's target. So maybe $1 trillion won't be worth that much in 10 years.
Maybe it won't, but I think most analysts would agree that NVIDIA is probably going to get there before. At least they're actual analysts who believe that NVIDIA will get there in the near term.
There are price targets that put NVIDIA at $8 billion in 12 months, 8.5 in fact. Let's bring back BlackRock Chief Investment Officer of Global Fixed Income, Rick Rieder. And Rick, can I ask you about that? I mean, is this market too frothy? Are valuations, are we getting too far ahead of ourselves here? Because I was looking at the other day, the Warren Buffett valuation, stocks, market capital versus GDP. It's at the highest level at least since 2000. And the same is true of the Shiller case. CAPE ratio, you can see this great chart here that shows you we're pretty highly valued on these two measures. Are you worried about the AI froth?
So, there's something, by the way, this is a time of year you tend to get momentum gets chased out of the markets, particularly today where you have ambiguity around some trends that are taking place. So, by the way, I don't think it's an AI bubble, and I don't think there's too much froth. And depending on where you go, if you look at some of the big hyperscalers that trade at 20 to 25, 26 times earnings, and they throw off ROE, return on equity, of 30, 35, 40%, and you look at their free cash flow. I've never seen in my career free cash flow generation. We can talk about top-line revenue growth. When you can have that much free cash flow generation, it allows you to do your CapEx, which is extraordinary today, build R&D, which is your future cash flow, and then you can buy back your stock. So what's happening, you have an unbelievable dynamic, and by the way, we're now about to open the buyback window, that you have this dynamic that you throw off immense amounts of free cash flow, and so there's multiples are not scary. There are parts, I see it in the private market, and I see it in some places where you're seeing businesses that have no cash flow for a number of years. How much would you finance those? So I do see froth in some areas, but in the traditional big market cap stuff, and I would say related to that, in semis, in healthcare technology, where you're seeing rapid change, but real cash flow alongside of it, it is the exact dichotomy of what you saw in 2002.
Why then do you have these large cap giants tapping the bond market to the degree they are, and not just the broadly syndicate market, but also raising capital off balance sheet too? If they were so confident and have such robust cash flows, is that not a concerning turn of events that they're instead building up on debt piles?
So first of all, when you look at any measure, debt to EBITDA, you look at their debt to book cap, debt to market cap, these companies are under-geared or under-levered. Their cap structure is so low in terms of leverage certainly relative to their market cap, but relative to their book cap. If you were running a big, mature company, you think about what does your normal cap structure look like, and if you're going to fund near-term CapEx over the next couple of years, if you can do it out the yields curve, which is where you see a lot of that financing take place, to say, gosh, I am throwing off a lot of cash flow, but if I can lock in these rates, and if I'm as a shareholder of any of these companies, I say, why in the world would you fund everything with equity? Or why wouldn't we put a little bit of debt, get a little bit of gearing, get your ROE higher? So I just think it's a natural evolution of, gosh, this is how you run a big company, and this is what a normal cap structure looks like.
I mean, we were just talking about global bond sales hitting $6 trillion, an all-time record. That's pretty incredible, and the return on fixed income has been great this year as well. Finally, how could we be in a world with tight financial conditions when this is happening? It just doesn't make any sense to me why the Fed would want to be cutting into this.
So you got what I would argue there's an immense amount of cash that came from certainly years ago at fiscal monetary stimulus. So, I don't think financial conditions are great for older savers in the economy. The interest rate tool today is incredibly powerful on parts of the economy that are really struggling. Low income, small business, the housing market. By the way, the government debt, since 89% of what the government funds is in 0 to 2 year part of the yield curve, so it has a huge influence on what taxpayers are paying for debt today. So my view today, what the interest rate tool does, the idea it affects inflation. I've been saying this for months. It's very hard for the Fed to bring down sticky inflation, healthcare, education, insurance. Not terribly robust. But you do actually, if you bring the rate down, you will bring down the mortgage rate, which you're seeing play out.
Well, but not for poor Americans, Rick. Diane Swonk has said, bringing down these rates is not going to affect subprime rates, and 25% of the country is below 690 with a credit score. Also, I don't see how a lower rate adds jobs in an environment where companies are cutting headcount to try and offset higher tariffs to their margins.
So, man, I've said this for months now. I will say one thing: the Fed doesn't create jobs directly, but you think about what happens. Small business does. 44% of the hiring in the U.S. is small business. The rate's too high for small business. Second, you think about what happens in the housing market. We put 3.1 people to work for every home built in this country. If you get the mortgage rate, by the way, you don't have to get it down that much, but if you got it down 25, 50 basis points, you increase labor mobility. Your point is right. Companies, we are in a productivity revolution. Companies are going to cut jobs. But if you increase labor mobility because people can sell their house, move to another state where they get a job, if we actually put people to work in building houses, you bring down shelter inflation. The Fed can't create jobs, but you can ameliorate some of the stress that's happening because of productivity. And people talk about productivity as like AI. It is happening everywhere. We talk about freight, how we do logistics, how we do inventory management, how we do customer procurement. Productivity is exploding. We don't need as much labor collectively in the country. You know, bringing that rate down in the places that can actually help will actually at the margin help a labor dynamic that I think today you'll see not just what you're seeing in the last 4 months, but what you're going to see for the next couple of years.
And Rick, these conversations, and especially your viewpoint, is made all the more important. We have to ask because last week, the beginning of last week, Secretary Scott Bessent confirmed his list for Fed picks, your name among them. How have those conversations gone?
No, I can't. I can't really comment. I wake up in the morning and I try and figure out the spline of the yield curve and what your comments about fast food versus Fed, like should we be buying this stock or that stock? That's what I got to focus on that. And so anyway, that's what I'm doing today.
Even
by the way, it's the most exciting time to do it.
Rick, even if you're not confirmed as Fed chair, everybody has a view about what they would do differently at the Fed. What are some of the changes that you would make?
You know, listen, all I'll point to is what I've said for many months now, is I think there are some things that you can do to create velocity in the system. You know, nobody borrows off the overnight funds rate anymore. Velocity happens where financing happens out the yield curve. Things you could do to keep that stability of the back end of the yield curve, to keep the mortgage rate in a place where we get real velocity, existing home sales moving. So anyway, I think there's some things that can be done that are interesting. And listen, Matt, I've said it publicly for many months now. I think if we're running break even, you can buy in the market today, 5-year inflation break evens at 2.35%. I think the funds rate should be at 3%. And I just think you could move it there, and then you don't have to go much further. I just think the price, in markets, if something's priced wrong, you get it there. I just think we can get it there, and then take another view on where are we today, and do you have to move higher or lower? But anyway, I think we could move rate a bit lower.
Well, Rick,
quicker.
It does have this feeling that whoever is next and whoever's next leading the Fed, that there will be this difference in tone. When we have this scenario where Chair Powell's term is up and we have our next chair in waiting, whoever that might be, how should that person handle that kind of lame duck gray period?
From an investor point of view?
Or just communication to the markets. How should that look when Chair Powell's term is over and we're waiting for the newly confirmed Fed chair?
Listen, I think it's tricky. I have incredible sympathy for, and quite frankly, the sanctity of what that institution is. I think what they will continue to do, and I think what they do today, is they make judgment based on, here's the data that we have to interpret, what is the right thing for the population at large in terms of managing that policy. And I really believe in this, and I certainly believe in this Fed chair and this Fed committee, that I think they're going to make the decision based on, let's evaluate the data, interpret the data, and make a decision based on that. And I don't think there's any reason to believe that happens any other way than that.
Well, Rick, you certainly do that for us, and we are very appreciative of it. To get all of your thoughts from what's going on with Bink to the labor market and beyond, Rick Rieder, thank you so much for joining us. Coming up on the show, the AI rally on pause. We'll discuss with Bloomberg Tech's Caroline Hyde. That's coming up next on Bloomberg Open Interest. A check on your equity market this morning. Here we are about 15 minutes into your trading day. Shaping up to be a rough day yet again. The NASDAQ should be notable that it's down 1%. We're headed for the worst week for the NASDAQ since the beginning of April. Some top calls for you, the analyst action that we're focusing in on. First up, Piper Sandler upgrades Expedia to neutral. They point to accelerated bookings and better operating leverage. Those shares after their earnings up 16%. Then Goldman Sachs downgrades Sweetgreen to a sell. They cite mounting pressure in a challenging operating environment. They also reported earnings that looked rough, shares down 8.5%. Finally, Morgan Stanley, they raised their price target on Sandisk to $263. They see data center strength continuing to drive upside. Those shares up 7%. Matt, one of the few tech stocks that is having a good day.
Yeah, Sandisk rising, Sweetgreen falling. It's not going to affect my lunch decision, nonetheless.
Good to hear.
Let's stick with tech. The stock market's AI rally is under pressure as traders question where OpenAI will get the funding it needs to finance its lofty ambitions. Bloomberg Tech co-host Caroline Hyde joins us now, and this has been a constant talking point. Even as, you know, these AI stocks have rallied so hard, if they want to spend $1 trillion by 2030, they're going to have to generate a lot more revenue to make it there.
At the moment, if they're going to make $20 billion in revenue, is that still enough to vindicate a $1.4 trillion build-out that they so far committed to?
No.
And no is many people's question. Look, Sam Altman has responded to what happened at a Wall Street Journal event on Wednesday with his CFO, Sarah Fryer. Sarah Fryer went on stage and basically talked about a grouping, a community, an ecosystem of banks, of private equity, but also potentially of government coming together to really help them finance here. And I think her exact words, they're looking for an ecosystem and the ways that governments can come to bear, the backstop, the guarantee that allows the financing to happen, that can really drop the cost of financing. Now, she's then since gone on to say the word backstop was muddying. I didn't really mean an actual guarantee. David Sachs came on to X and said the AIs are saying we are not bailing out big AI players here. There's lots of front-end models. Then Sam Altman put out an incredibly long piece on X, really detailing where they think government can play a role. It's if they got into chip manufacturing. Otherwise, they don't want government help. But all of this goes on to really try and understand the vindication for where they're financing all of these data center build-outs. And thus far, it's been doing in more and more interesting off-balance sheet deals, getting involved with AMD, maybe then AMD giving their chips, but everyone's trying to question really whether the revenue is going to scale at the amount that he thinks it will. He's saying by 2030, we'll all be cool. We'll make hundreds of billions of dollars of revenue. But clearly the market is still questioning it.
There's been some really great work from the Bloomberg team, though, about just what a behemoth it is, the manufacturing capacity that's being put behind AI. There are estimates of how much it's contributing to American GDP, and those are outsized, too. Caroline, I feel like if there is a downturn, it wouldn't be crazy to say that the government steps in with support, just given how much of a keystone it's become for this economy.
And I think that alarm bell's been ringing. If you think this has been a long week, but like Michael Berry at one point this week was re-identifying. That was this week. But he was putting out that incredible chart that Bloomberg had put together of basically all of the deals and where all the money's flowing in the same few players. Are we becoming so big?
Oh yeah, we've got
fail?
a great version of that chart, actually. Joe, if you can pull that up, that would be great.
And I think that just goes to your point that if everyone's intertwined, if the entire economic growth story is backed by the AI overall focus, I mean, what if we got another DeepSeek moment? What if we suddenly realized we didn't need the amount of compute that we're all trying to put into
or the amount of electricity to get that compute?
How are we getting the power?
That's the big concern. All right, Caroline, really looking forward to your program, Bloomberg Tech, at 11 o'clock. We're going to get that chart up for you, I promise, because Joe is very fast at doing. There it is. See? This is a beloved chart over the past couple weeks. We could update it with Dell and maybe a couple other players.
You can make it look crazier.
All right. I am very excited because on the Fed decides last week, Diane Swonk came on, and every time she talks, I learn something. I understand things better. And so I see her getting mic'd up right now. She's in the studio with us, so we're going to talk to Diane Swonk in just a bit. Plus, feeling the pain of Bitcoin's downturn, how ETF traders are trying to overcome the cryptocurrency's drop. That's next. This is Open Interest. This is Bloomberg Open Interest. Quick check on what's going on in stocks right now with the chicklets. Bring them up. The S&P 500 down 0.7%, and the Nasdaq down more than 1%. We've had a couple of days of big drops already this week, so the air seems to be slowly coming out. Right now, you can see the VIX is now up at 21. So if you're used to seeing a VIX at 15, if you've grown up that way, it could change. In terms of the stocks, Nvidia is a big one pulling us down, off 2.5%, and Tesla down 4.6%, even though a vast majority of Tesla shareholders voted on Elon Musk's, positively on Elon Musk's $1 trillion pay package. The travel companies have been doing well. Airbnb, not as well as Expedia, up 17%. We were talking to Mandeep Singh about that. The most delicious fast food restaurant of all, Wendy's, up 3.33%, although it's done horribly. The stock has underperformed McDonald's and Burger King and pretty much every other fast food restaurant you can think of. iShares Bitcoin Trust down, getting taken out a little as the underlying asset falls, down only 1/3 of 1%. But Bitcoin has, I think, erased, Dani, pretty much all of its gains for the year.
It is currently down for its worst week since March when it comes to the entirety of the year. I can give you that too, Matt. It is still up 7.3%. So not completely, but it's surely eaten into a lot of that. And
Thank you for fact checking.
Of course, always, that's what I'm here for. Powered by the terminal. And you pointed out there what the ETF is doing. The ETF has helped Bitcoin reach a new record, but as we've been talking about, it's now fallen 20% from its peak. So how are those ETF buyers feeling? Joining us now is ETF analyst James Seyffart of Bloomberg Intelligence. James, great to see you as always. How have ETF buyers of this piled in, helping the rally in Bitcoin? How much are they behind some of the drop we've seen in the cryptocurrency?
Yeah, I mean, they've seen, so to be very clear, as a group, the US spot ETFs have taken in at a peak 62 billion in inflows, right? They've seen about 3 billion in flows come out over the last, we'll call it month, or really 2 weeks. But ironically, yesterday, we actually saw a huge dip buy. We saw $240 million come into these things. So in the grand scheme of things, yes, there's some money coming out. And with like this price volatility, you'd expect some people to run a bit. But I think for the most part, people buying these things understand what they're getting into. Like, people think of Bitcoin and crypto and they think crazy, volatile, and that's what you're going to get here. That's how these things operate.
First of all, it's only November 7th, so respect. Respect to you, James Seyffart. In terms of, spot ETF flows, are they still sticky? Are they becoming really momentum products? What do you think?
No, they're definitely sticky. I mean, for the most part, what we think is happening. So obviously, you think of the ETF world, but there is plenty of those, spicy 2x leveraged single stock products. There's these crypto products that are leveraged, those 100% yielding products. There are a lot of people that are going after that space, but for the most part, most of the money is like longer term oriented to their investing process, right? And what we think is happening likely with these ETFs is it's mostly people putting, 1%, 5% allocation in their portfolio, and they understand what they're getting into, right? Bitcoin, for the most part, including these ETFs, tend to go in this, 2-step forwards, 1-step back motion. We had a great bit, you talked about it already, but we had a bigger drawback in March and April of this year. It was over 30%. If we go to like that same sort of pullback, we'd be in the $89,000-ish range for Bitcoin. So is this the beginning of is this part of one of those, 2-step back, 1-step back moments? Or is it one of those, giant leaps back where Bitcoin and crypto fall back 50, 70%? I don't know the answer to that. But for the most part, I think people that are allocating 1%, 5% allocation, they know what they're getting themselves into. And that's why we see this money not really leaving. There has been outflows, but in the grand scheme of things, 99% plus of investors have stayed put.
All right, James, thanks very much for the breakdown there. James Seyffart of Bloomberg Intelligence covers ETFs for us today on crypto. Winter may be coming. Coming up in the next hour, Diane Swonk of KPMG following fresh consumer sentiment data, plus the CEOs of Activate and FuboTV, and part of Dani's interview with tennis legend Serena Williams. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. Another negative day, a second one in a row for these equity markets, with big tech leading the declines. We're on track for the worst week that we have seen since April, the beginning of April, and the tariff news that was announced then.
Yes. Liberation Day.
Liberation Day, that's what I was
trying
looking
to
for.
remember.
Correct, thank you.
What a catchy title that was. All right. We have breaking data on the terminal. Bloomberg shows University of Michigan consumer sentiment less than had been anticipated and less than the reading prior. Let's get over to Michael McKee right now, Bloomberg's international economics and policy correspondent. He's got the rundown. Mike?
Well, to paraphrase Dan Quayle, you are not happy campers. Happy campers, you unhappy campers, you remain. 50.3 for the University of Michigan sentiment number. That is the lowest since June of 2022. The current conditions index falls to 52.3 from 58.6. That is a record low for the current conditions index. Expectations, 49. From 50.3. So we're seeing some very disappointing numbers in terms of overall feel for the economy. In terms of the numbers that'll matter to the Fed, the expectations for inflation over 1 year, 4.7%. That ticks up 1 basis point basically from 4.6%. And the 5 to 10 year falls, however, 3.6% from 3.9%. So there may be some faith out there that the Federal Reserve will keep things in line, but not over the short term. So unhappy campers right now we have around the United States.
Market reaction is limited. We are basically where we were before this data came in for the 10s, 2s, the S&P 500. Amused is the wrong word, Mike, but I'm always curious about the inflation expectations. 1 year at 4.7%.
Yeah, it's not amusing at all.
No, but it's extremely high and maybe out of touch with reality.
Yeah.
I mean, 4.7% is extremely high.
The rent is...
If you followed the University of Michigan numbers for years and years and years, you know that Americans have no idea what the inflation rate is. And so they're sort of guessing at this, and it's really kind of the movement up or down that you watch for rather than the specific point levels. The New York Fed does a consumer sentiment survey of inflation expectations, which is actually being released later today, usually on Mondays. And theirs is a little closer to the numbers. I don't know why that is in terms of who they talk to, but you can't take the 4.7% necessarily seriously as a number, but the idea that it's that high is not good news.
All right, Mike, thank you so much for breaking down the numbers for us. Bloomberg's Michael McKee. And joining us around the desk is Diane Swonk, KPMG chief economist. Diane
also went to Michigan.
Yes, so I'm sure.
Got to get them both in.
And Chicago, but you, I know you graduated, the year you graduated, you beat Ohio State also. And you had a really good run there in the 80s against OSU.
So
there was a while,
yeah.
yes.
So I'm sure these numbers then.
Well, no, the last 4 years have been incredible too, but this year we're going to put an end to that.
Thank you for that, our sports update of the day. So I'm sure these numbers are very near and dear to you then. But Diane, it just has this flavor of it's like pick your own adventure. Look at Sweetgreen, things are bad. Look at the fast food restaurants and travel, people are spending. Consumer sentiment at a record low in the latest University of Michigan survey. Not to mention we're not getting official government data. What do you do with all of that?
Well, I think, first of all, you know, I think often of a line that Jay Powell said at Jackson Hole, and that is, we're navigating by the stars under cloudy skies. And that's really what it feels like. We don't have the guidance that we'd like from the official data, but the unofficial data are sort of reinforcing what we already knew, and that is that inequalities are widening, that low-income consumers are really struggling, and that the economy is adding up on paper to look much better than it feels to most Americans. That's because we're seeing much of growth powered by one sector alone, the AI boom and the data center boom, which is got a backlog on it of more than a year and a half. So we know that's going to continue, but it's happening against this backdrop of what I call sort of a jobless boom. It's not that we have no jobs, although we have a lot less, and likely in the month of October, although we don't have the data, it probably contracted. What was interesting in the first round of the consumer sentiment survey was that the first round of consumer sentiment survey for October, although it was weak, it showed really very little connection between what was going on with the government shutdown and the overall economy. My guess is that is now shifting because people are seeing flights canceled, they're seeing disruptions in services, they're not able to get small business loans. All of that is adding insult to injury at a time when we knew 151,000 government workers were going to fall off of federal payrolls that had taken buyouts earlier in the year. So the month of October, although we don't have the employment data, the mixed numbers we're seeing suggest we probably had a negative read and the unemployment rate moved up to at least 4.5%. That is a little above sort of where we consider the non-inflationary rate to be, or close to the non-inflationary rate. But that number itself also understates the undercurrent in the labor market. We know the ranks of the long-term unemployed continue to rise, and some are actually falling off their unemployment insurance. So we're seeing layoffs pick up, but those people aren't reflected yet in those numbers.
By the way, it's very bad news when we have a shrinking labor pool, right? I always talk to Mike McKee about this in the hallways. If we have fewer and fewer workers, companies should be competing for them, paying more for the next marginal hire. But instead, they're not hiring because they need to offset the margin hit from tariffs, right?
That is part of it. Also, uncertainty is causing a hesitation in hiring.
But are rate cuts going to help that, Diane? If the Fed cuts rates,
that's
is that
a great question, because what we don't know is how much of this is just demand-driven, how much of it is more structural in nature, and we do also have curbs on immigration. At the same time that we're seeing the labor market weaken, there are pockets where there are labor shortages. In the month of September, we did get the CPI data. We'll likely lose it for the month of October, and we're getting close to losing it for the month of November as well. But the CPI data really revealed some of that shortages of workers in key places. We know it's happening in food services. We also know that childcare went up at its third fastest rate on record. That's one of the reasons that women with children under 5, especially with BAs and above, are dropping out of the labor force now after moving back into the labor force over the post-pandemic period. But we're also seeing that the cost of in-home elder care, which is very dominated by immigrant workers, that went up at its fastest rate on record.
That's sad and difficult for a lot of people to deal with, but the child care thing is a problem for the future.
But also
right?
both those things really impact women. Like they impact half of the workforce, both of those.
But also the kids, right? If you need to be taking care of kids in order for them to become good functional adults.
And you have to be able to feed your babies for them to become functional adults and be able to learn. And one of the things on the in-home elder care, this is really interesting. We saw data in September on that, excuse me, and what was important about it was that what we saw was after 21-22, 60% of all those doing in-home unpaid elder care were women. 40% were men, unlike childcare, which is dominated by women. In the most recent survey, 23 and 24, 56-44 women to men. In the younger age groups, 15 to 24 and 25 to 34, dominated by men doing in-home elder care. And that explains some of the missing men that we're seeing in the labor force, especially the young men who aren't participating. Some of them are not just sitting home on their parents' couch. They're actually taking care of someone unpaid in their home.
And that's going to get worse, obviously, as demographics. Listen, I thought the Fed Decides was excellent last week. You joined John and Tom and Bob and Mike and everybody else, and you made a really interesting point, which is that cutting rates isn't going to help the subprime borrower.
No.
And then after you said that, Torsten Slok sent out a message to we're all on his mailing list, pointing out that 25% of this country is subprime, which is, defined as a credit score below 690. So it's not going to help a lot of people get cheaper loans for cars or get mortgages for homes, as we hope.
Auto loan rates have actually risen since the Fed cut, and auto loan rates are extremely high, and they're above where they were a year ago. So it doesn't make it easier. And then on top of it, we're not going to go into a recession because there's a huge, huge tax refund, the largest tax refunds on record across the board. And they didn't change the IRS withholding rates before then, so they get a big bump at the beginning of the year.
Well, let's hope the IRS goes back to work.
Yeah, that's very important. But on the other side of that, that's both good and bad because it's a double-edged sword, right? Because we are going to be seeing broad-based gains around in the first quarter as people get those refunds. They'll be able to buy cars. They'll be able to pay off some of their debt. But at the same time, we know that same kind of fiscal stimulus at the time that we're getting this tariff-induced inflation, it could make it stickier. And that's one of the things we're very concerned about, is that we know a lot of firms who have been holding off raising their prices or trying to absorb some of it through layoffs. Now they're going to be passing it along because they're getting to the point that they no longer can do that. And that's especially for the middle market firms, and small businesses are really taking it on the chin right now.
So if cuts aren't going to help the subprime borrowers that desperately maybe need the help at this moment, and instead you're about to get an injection of stimulus at a time where bond sales are hitting records, that equities are hitting records too. So on that measure, financial conditions are extremely loose. Is it a mistake to be cutting? What happens if we're cutting into that environment, especially with the Fed next year that is much more willing to cut based on what we assume the composition to be?
Exactly, and that is one of our concerns. And I think one of the reasons you're seeing, you saw Jay Powell sort of do this odd sort of dance at the press conference that followed the announcement. You had, dissents in two directions, but, he talked about the very disparate views around the room. The debate is healthy, but it's going to get heated. And, we're going into the December meeting where we know that inflation by some of the private sector measures is accelerating. We can't, we don't know what that means for the PCE, and we're going to lose what the Fed targets, that PCE measure of inflation, because of the CPI loss in October already, and we're cutting into our ability. This is where the data blackout really matters. And it's why he cautioned about what are we going to do at the December meeting, that, it's not a foregone conclusion, to use his words, that we get a rate cut. And I think that's actually a very wise place to be, even though I'm very worried about the undercurrent in the labor market and what that means, especially for entry-level workers who really are left wanting and want to get into a job.
All right, Diane, great having you in the studio. We're glad you joined us on the East Coast here from the Midwest. Diane Swonk, normally in Chicago, but a Michigander by birth. Yes. And an alumni as well. All right, coming up, the so-called beige book of tech. Activate CEO Michael Wolff joins us to discuss his report on the major trends that will shape technology in the years ahead. This is Open Interest. Getting out of high interest, look what's making headlines around the world. Tesla shareholders approved a $1 trillion pay package for the CEO Elon Musk. It's the biggest pay package in any kind of history, corporate or non. The vote clears a path for Musk to become the first ever trillionaire and expand his stake in Tesla to 25% or even more over the next decade. U.S. airlines have started canceling flights scheduled for the coming days as the government shutdown continues. The FAA says the reduction is needed to ensure safety. According to aviation analytics firm Cirium, out of over 25,000 flights scheduled for today, fewer than 3% have been canceled, so it's not that bad yet. And the reductions don't apply to international flights. Target is telling its store employees to smile, make eye contact, and greet or wave when a shopper is within 10 feet, which seems like it would be obvious, but they have to tell their employers to do that. Employees should ask if they need help, the shoppers, or how their day is going. They should just generally be nice and polite. It's a new initiative, part of Target's efforts to make stores more welcoming and reverse its streak of weak sales. What a great idea, Dani.
Okay, I think it's great to be nice and friendly, but mandate a smile, it kind of feels a little bit dystopian to me.
I don't know. Who uses the word mandate? They're just saying, like, smile, be nice, be attentive, pay attention,
Yeah, I don't know. Anyone telling me to smile more, alarm bells go off.
Yeah, you smile enough.
Yeah, I think you're right. Thank you, Matt.
You want to turn to tech?
Let's do it. And turning to tech, very far away from the smiles and grins, although you would probably smile about this. Consulting firm Activate released its technology and media outlook report for 2026. They forecast $1.3 trillion in new growth through 2029. Activate co-founder and CEO Michael Wolff joins us now. Michael, great to see you. And $1.3 trillion. To my puny little human brain, that sounds big and like a huge opportunity, but can you actually just put that in context? How big of a growth exactly is that, and where does it come from?
It comes from about 400 million comes from the consumer internet sector, and that's growing. And then there's 900 million additional growth dollars in B2B tech. And so you can see that overall, you see that the B2B side is going to add a great deal more money. And then that includes a lot of the new revenue that's going to come from AI over the next years. But the consumer side, there's going to be significant new dollars coming into the global industry.
From Where are they coming from?
Oh, they're coming from everything from advertising to subscriptions to sales. I mean, if we look at their places like we see video games, it's going to be a $214 billion business within 4 years. We're just going to see there's going to continue to be, people are going to spend more time, they're going to spend more money. And a lot of this is growing because, yes, people are spending more time, more engagement. They're doing multiple things at a time with technology and media.
So how does this improve productivity? If it does, Michael, what's your take on that? And what does it mean for the labor market? What does it mean for society?
Well, let's start with people. I think some of the people they're freeing up more time for doing things that are leisure or information, because a lot of the apps that we're using that are going to be driven by AI just make things so much more efficient. It's that time you're going to save in terms of calling an Uber, that time you're going to save in terms of ordering online or ordering from Amazon or Target. So that's on the consumer side. On the B2B side, we're actually much more upbeat about the ability for companies and people in those companies to do more work without. We're not going to lose many of the jobs. I mean, what we keep seeing in many sectors, even though AI is more efficient at doing jobs, that there's still more skilled workers are needed.
Michael, one of the things that feels like it's really picked up steam are all these various AI video platforms that you plug in whatever you want and it gives you a video. And because of that, it is the AI slop of the world. I've had my father-in-law, for example, send me a video of like a dog rescuing a baby from a pool that's obviously AI, and I don't know why it exists. Are we about to just be inundated of a world of AI-created content everywhere? Does the quality of things people are producing, is it just set to plunge?
Well, let's put this in context. It's clear video is eating the internet. So much of more of what we're seeing is driven by video. So if you look at social media, if we look at 5 years ago, social media, roughly 41% of it is video. Today, it's over 70%. And by the way, most of that is not coming from your friends. It's coming from influencers. So we're looking at in the case of TikTok, it's almost 85% of the videos. In Instagram, it's over 70%. And a lot of those videos are going to come from AI. Just in the last month, both Facebook, or Meta, and OpenAI released their own TikTok-like platform so that you can scroll through just AI-driven videos. And that's only going to intensify. And it's another way in which creators and people are going to share videos. And a lot of them are fun. I mean, a lot of them are some of the same things. The giant shark eats the boat, or packages blow up in people's faces with paint on them. But we should expect to see more. They include, people are incorporating Jar Jar Binks into their family photos.
Oh, don't get me started on Jar Jar. Dude, that was a huge mistake.
It certainly
question what George Lucas was thinking and why he hasn't apologized to the world yet. Can I ask Michael about, we're seeing these glasses come out and, these Vision Pro things, and I wonder, what do you think the medium is going to be? Is that going to change over the next 5 years or 10 years?
We're very upbeat about what's going to happen with AI glasses and spatial computing overall. I mean, both VR and AR. And part of the reason is we're going to move, so many of the biggest technology companies are investing. If you look at pretty much the largest technology companies in the world are all putting efforts behind spatial computing, which is those AR and VR. And part of the reason is, or to the large extent, what they're doing is they're betting on a post-smartphone future. They're betting on a world where we're not going to be looking at our phones, but we're looking up, and it's either going to be bringing AI into the real world, essentially a heads-up display for everything else in our lives. So even though the sales aren't there yet, they're putting that cash in because they do expect that this is going to be a new mode for us to enjoy entertainment and put AI into our lives at the same time.
Hey, Michael, really wonderful to get your thoughts. Thanks to you for bringing that after your latest outlook for 2026. Michael Wolff of Activate. Still ahead, we're going to bring you part of my interview with tennis legend and turned tech investor Serena Williams. That's coming up later this hour. Stay with us.
Let's get a check right now on the stock market using the move screen. This is the S&P 500, and you can see that even though, once again, breadth is pretty evenly split. 274 up, 226 down. So breadth is stronger to the upside, and yet we're off right now about 0.7% Apple is helping out a little, as is Exxon, Berkshire, Chevron. So oils are up, but Nvidia is the big weight, off 2.7%. You see Alphabet, Google, and Tesla down, as well as Broadcom. Take a look at the week, right? This is year to date. I thought we were going to look at the week for groups. There we go. You can see that IT is the biggest loser this week. Over the last 5 days, down almost 5%. And I believe this will be the first down week in 4.
Yes.
We'll double check that. Coming up, FuboTV is closing a deal to combine with Disney's Hulu. We'll speak to the CEO. Two competitors in the TV streaming wars are joining forces. Fubo and Disney's Hulu reach a deal to combine businesses despite remaining separate services. Disney will hold about a 70% interest in the new company, so it's the acquisitor here, with Fubo owning the remaining 30%, the seller. For more on the deal and the landscape of streaming, we welcome David Gandler, FuboTV co-founder and CEO. David, what a deal. What a tremendous company with which to do business. What kind of opportunities does this provide you for the future, for the growth of your company?
Yeah, well, I've said on the earnings call, it provides us with unprecedented opportunities to grow, multiple growth drivers across marketing. We'll be able to market across ESPN's 100 million plus monthly active user base. We've transitioned our advertising sales team to Disney. It has been I would say, the only blemish on an otherwise phenomenal quarter for us on a standalone basis. And it also provides opportunities to partner with their, multi-$100 million user base internationally to really grow a business of consequence in the streaming space, both domestically and internationally.
David, how do you think of the brand? Because as you mentioned with ESPN, for example, there is some overlap of sports, maybe you have Hulu for entertainment, but how do you keep the channels distinct without confusing the consumer?
Yeah, look, I think that's a great question. We went into this really trying to double down on our strategy, which we've highlighted, for the last 18 months, was really around super aggregation. We want to provide consumers with choice, flexibility, with a value forward experience, across different price points along the demand curve. And this transaction allows us to, really offer a product to consumers in Hulu Live TV, which is more of a larger, complete entertainment bundle. Then you have a separate package, which is Fubo, which is slightly skinnier, oriented towards the sports fan. We've just launched the Fubo Skinny package, which is performing really well for us as well. And then we have what we announced yesterday, which is the Fubo Channel Store, which gives people an opportunity to buy into standalone services similar to products that Amazon offers in their Prime Channel Store. So, giving people a plethora of choices, leveraging our data, I think will allow us to really provide consumers with tremendous value.
What can you do, to raise revenue and profitability in terms of I guess subscription first, but also, we talk all the time to Mark Douglas from Mountain about targeted television ads, smart TV. What can you do to really get the right advertising to the right customer?
Yeah, well, that's the beautiful thing about our business and the combination with Disney's Hulu Plus Live TV is we do not have any overlap in customers. It's not like merging two streaming services that have some overlapping customers. In the virtual MVPD space, there's no reason to have two of these services. So basically we're adding a significant amount of reach, which is always important, particularly when you're focused on targeting, whether you're targeting, demographics, psychographics, and I'll even go as far as to say is you can now, with Disney and Hulu Live TV, we can actually target to the zip code, whereas Fubo was not able to do that to really drive greater demand and obviously CPMs for our inventory. This is a huge opportunity to really leverage all of our data and put it in the hands of a sales force that's over 2,000 high qualified account executives. So we're very excited about that piece of the business and the growth opportunity there.
David, even in just listening to you, explain some of your offerings, there are a lot, right? And you're not the only one out there. It feels like a very crowded market. I wonder, just taking a step back and looking at the media landscape as a whole,
right.
Do you think that there's just more consolidation to come because of, at the moment, a very wide array of offerings to a consumer who, in some cases, is starting to feel the pinch?
Yeah, look, I think if you look at our offer to accumulate or aggregate a complete NFL package, I think with Fubo at the core, you can do that with the least number of apps at the lowest price, which is very important. I think people are getting very tired. I've said this over the years about friction and fragmentation. It's difficult to find programming. I've also made comments as far back as 3 or 4 years ago where I said we'd go from bundling to unbundling to rebundling. I think that's happening. And, we sit, if you think about a spectrum, Fubo sits right at the consumer, whereas, OEMs, sticks, and devices, they sit at the other side of the spectrum. So, our goal is to really leverage the 2 billion data points that we collect, and create value offers that we think, consumers really love. And we've built a brand, as you know, an identity around sports. We have over 50,000 sporting events on the platform. We continue to add more sports, and we're excited to be able to work with Disney, on really driving domestic and international growth going forward.
David, because of that, you're in a great place to
Absolutely.
Help us think about the future of sports. And we've seen, over the last 5 years, we've seen this massive rise in Formula One, which Dani is obsessed with. We've seen a growing popularity of women's sports like the WNBA, women's hockey. I love personally motorcycle racing, which hasn't really caught on that much in the U.S., but is starting to build up. What do you think we're going to see in terms of the evolution of sports? What's more popular? What do you think we're missing over the next, say, 5-10 years?
Yeah, look, I think that there's a lot of innovation in sports, and you see a plethora of new leagues attempting to, really take advantage of streaming. I've seen a number of new projects in the rugby space, which I think can be quite compelling. I'm really excited about flag football. There's probably an opportunity to engage both women, men, in that space, particularly ahead of the Los Angeles Olympics in 2028. But you're going to see lots of different types of sports, variations of sports we already know. To really drive engagement. I think it's really competitive, really compelling, and it's a way for people to actively, watch television. It doesn't always have to be passively watching dramas, and other entertainment programming. So again, we're very bullish on this, especially when you think about the capabilities around betting, as well as, all of the different, companies like Polymarkets that are trying to get into the space and be innovative. So all of this, I think, really creates opportunities for companies like us to improve engagement and drive revenue.
And David, you understand the sports business from multiple angles because you yourself, through Gandler Sports Group, have also invested, for example, in a football club. You previously were a co-owner of Paris FC.
Football like football or football like soccer?
Soccer, football. But it's an English football league club, so I have to say football, obviously. David.
Yeah.
There have been lots of remarks just about the institutional money getting into sports, especially European sports and football/soccer. Are you concerned that valuations are being driven up unduly because of that?
Look, I think you're always going to find opportunity. Just in my case, I found a phenomenal club, as you said, called Paris Football Club. That is not Paris Saint-Germain. It's sort of the number 2 club in the space that, I was able to sell to the Bernard Arnault family office of Agache. So there's always going to be opportunities, just like in any business segment. I think the goal is always to look for value and develop assets that you think that have a long-term opportunity to grow. And I think European sports are a great place to invest. Obviously, the valuations in the United States are extremely high. But you see deals most recently with the New York Giants, where the Giants completed a sale at a $10 billion valuation. So again, these are great alternative assets to own. Obviously there's supply demand equations here as well. But I think for many reasons that I think people like to own these types of assets for the long term, and I think that will continue going forward.
David, thank you so much for your time this morning. This was really fantastic. David Gandler of FuboTV, please come join us again soon. All right, let's get a check in markets. Over an hour into your trading day, we are still down quite heavily for the NASDAQ 100, down 1.33%, headed for the worst week since Liberation Day, as yields are little changed after we got Michigan Consumer Sentiment Survey data at the top of the hour that showed one of the worst readings that we've seen in some time for 2021 for future conditions. A painful reading there, but stocks continue to fall, led by tech, Matt.
All right, we are keeping an eye on airline stocks this hour as the impact of the longest government shutdown in U.S. history hits travel. More than 700 flights were canceled just today by the 4 biggest U.S. airlines. Nora Melinda joins us now live from Newark Airport. And, we talk, Nora, often about Newark Airport. It's so difficult to get to. The roads are very confusing in that state. And they have a pretty bad track record in terms of cancellations. Is it one of the worst affected?
So we are seeing a lot of major airlines, or major hubs, I should say, across the nation being affected. If we look at Newark specifically, Newark Liberty Airport is seeing more than 40 cancellations today. And if you look across the U.S., that's about 3% of cancellations that we're seeing across the nation. But this is still well below, of course, the 4 to 5% of cancellations that we tend to see if you think about a bad winter storm, or maybe the 10% that we see when we do see a storm affecting a major region here. So this isn't the worst case scenario. This isn't the worst that we've seen as we're thinking about cancellations. But you're definitely seeing a lot of travelers trying to get here early. I mean, if I think back to us getting here right before 5 a.m., we did see droves of individuals coming in through security, trying to get on their flights and making sure that they can get there before any sort of cancellation or delay.
So you see some of those 30 core airports that we're looking at now, seeing some of the pain going forward. Nora, what does this mean for the airlines themselves, for companies that are reliant on travel, the Airbnbs, the Expedias of this world that just had good earnings? What does it mean for them if this extends on?
So in terms of the actual bottom line and how this will affect the bottom line of a lot of these airline companies, and of course, as you mentioned, a lot of the other travel-related names, that still remains to be seen. A lot of analysts still crunching the numbers in terms of expectations here. But of course, we are just thinking about the fact of a lot of people not wanting to come to work, maybe calling out sick, especially as we think about TSA agents, air traffic controllers that have been going unpaid since October 1st. So the repercussions of that in terms of how long this shutdown continues is really what's going to be weighing here on the mind of a lot of individuals, and of course as people think about the economy moving forward.
Nora, thank you so much for your excellent reporting this morning. That's Bloomberg's Nora Melinda from Newark Airport. Coming up, it's being added to literally everything: coffee, popcorn. Wall Street Week digs into what's driving that protein boom. We'll show you more delicious food video coming up next. This is Bloomberg. Time now for our Wall Street Week conversation, and you can find it literally everywhere. Lattes, chips, Pop-Tarts, water. David Weston explores why protein is being added to virtually everything and what it means for consumers and for companies.
American consumption of protein from animals and other food sources is up, but so is the use of protein supplements from new companies like David Protein, maker of protein supplement bars. Its co-founder and CEO is Peter Rahal.
In our first year, we'll do 150 million in sales, which I believe is the fastest growing food company. And next year, we're forecasted to 300 million plus.
Before David Protein, Rahal founded RX Bar, which he sold to Kellogg for $600 million in 2017.
Americans we keep jumping from different diet trends. So first there was Atkins, then there was the paleo diet, then there was Whole30, and then there was keto, fasting, plant-based had a moment. And if you look at the fundamental reason for those trends and what drove them, they're really around body composition changes or weight loss. Every January, everyone feels like they need to get back in shape, and so you're looking for diet as a solution to that. We don't want to be susceptible to those diet trends, and we wanted a position that was factual and around something that is true.
But do we really need all this protein? Barrow says that for most Americans, the quantity of protein itself isn't the problem.
For the average American, we recommend 10 to 35% of your total calories should really come from protein. And so narrowing that down to, let's say, a 2,000 calorie diet, if 10% of that needs to come from protein, that would be 200 calories of my total protein needs should come from protein. And then equating that to grams of protein, that would be about 50 grams of protein for the average American. And so if you want to translate that to what that means in terms of food, if you eat a 6-ounce piece of steak, that's going to give you about 50 grams of protein, which is plenty for your protein needs for the entire day.
What explains the recent interest in protein, and why is consumption on the rise? Rahal says part of the answer is GLP-1s.
For the first time, we actually don't have Americans going to a diet to lose weight. We have Americans going to a drug to lose weight. And so that's changed this whole entire pattern in how Americans are thinking about nutrition.
Roughly 8% of the U.S. population is currently on a GLP-1 weight loss drug like Ozempic or Mounjaro. And that number is only growing. Doctors recommend that GLP-1 users consume more protein to prevent muscle loss from eating fewer calories overall.
David Weston on the rising demand for protein in the U.S. And you can watch Wall Street Week tonight and every Friday at 6 p.m. New York time, because protein's literally in everything. It makes no sense. It's in water.
I like to have protein from chicken and steak, as well as salmon.
Sounds delicious.
Yeah, so good.
Here's something the New York Times wrote this year. The average man in the U.S. and average woman actually overshoots their protein intake. We don't have a protein problem. I know you look surprised by that.
Believe that.
It says men overshoot it by more than 55%.
I don't believe that. You should be getting like a gram of protein for every pound that you weigh if you're trying to lose weight without
Isn't that if you're like working
muscle.
out too, though?
Yeah, that's part of
losing
weight.
I don't think every American is working out that much.
Coming up, we're going to talk about someone who works out all the time. Serena Williams. We're going to hear from arguably the greatest tennis player of all time.
The GOAT.
After a legendary career and the learning curve that came with launching a venture firm. And the coolest part about this interview is that Dani did it.
Thanks, Matt.
Yesterday in Miami. This is Bloomberg Open Interest.
Nearly a decade after launching Serena Ventures, Serena Williams is channeling her competitive spirit into investing. She spoke with me yesterday at the American Business Forum in Miami about planting the seeds of her business career before she had even left tennis.
When did I think of me as a businesswoman? That is a really good question, because I feel like I've always thought of me as a businesswoman. I think when it came to sport and when it came to things that I did in sport in particular, listen, my job was a business. You know, it wasn't for me just about going out there and hitting tennis balls and winning. Obviously, that was the biggest part of it, but it was also really about being a business, being an entrepreneur. And at the time, when I was doing all this, there was lots of things and lots of people saying that you have to focus only on tennis, that you can't do other things, you can't have this other stuff, you can't be an entrepreneur, you can't think about other businesses, you really just have to do tennis. And I pushed that envelope and I said, you know what, that's not me. I am a kind of person, I was taught from an early age, actually from my father, that it was really important to have a plan B. I don't know if he thought that I would do decent in tennis or not. Maybe that's why he told me I needed a plan B. But that's something that kind of always stuck with me. And so when it came to what I wanted to do in sport, whether it was fashion or whether it was design or whether it was investing, it was something that was always going to be this entrepreneur. And now the new modern athlete, if you think about it, the modern athlete, if they're only playing their sport, then now that's frowned upon.
True.
So I love seeing the difference of how it started versus how, people look at sport as an athlete now.
I mean, what a plan B. A lot of people spend all their lives even having that as their plan A. But when you decided to make it your plan A, when you announced in 2022 that you'd be stepping off the court, did you have any hesitation or any concerns about leaving tennis behind?
Absolutely. My whole life has been tennis up until when I retired. And I always thought, I actually never knew when it was going to happen. I always wanted to retire, but I actually never did it because it just wasn't realistic. Imagine growing up from as long as you can remember having a tennis racket in your hand, and then one day it's just done. And the thing is, you expect it from the moment you have that tennis racket in your hand, but you never really expect it until it's over. It's just this weird feeling.
My conversation with Serena Williams there. And Matt, one of the things that stuck out to me is, you heard it there, her saying that if you're an athlete, you're expected to have a plan B. You're expected to be an investor. We've seen a lot of athletes and just celebrities in general become investors. Not all of it has been successful. You can argue she's been successful, but Kim Kardashian, for example, the reporting has been for her fund, they struggled to fundraise and they struggled to buy anything. So still, they have to fight the stereotype of why should you be an investor? Why should we give you money? But Serena has been successful in that.
Right. Well, she's clearly also an incredibly intelligent person. You know? And some people are born with all of the brawn and not all of the brain. She's got both. This was particularly interesting for you because you're a tennis fan, like a tennis player, a fan of playing tennis yourself. Did you get any tips from her?
No, so my tennis coach actually told me I should ask her, but it felt like going up to Beyonce and being like, hey, Beyonce, I sing in the shower. It didn't feel like the right scale to ask about it.
Okay, but you could talk to her about investing, about markets, about...
By the way, she said her 6-year-old daughter, maybe 7, Olympia, is currently interning at her and her husband's company. So...
That seems a little young for an internship, but cool.
Yeah.
My daughter loves coming to work also, but just because we have snacks.
That's a great reason to come to work.
All right, very cool. Can we see the whole interview on Bloomberg.com?
You can see it. It's posted on YouTube from the American Business Forum itself. Highly recommend go and watch it.
All right, very cool. I will search that and watch that. Let's get a check on what's going on in the markets as we head to the end of the program here. We're down 1%, so we could be finishing the first down week in 4. Of course, a lot can happen between here and the close. Coming up on this program Monday, we have 2 special conversations for you. St. Louis Fed President Alberto Masalem and AQR's Cliff Asness joins us, as well as Marta Norton. That's 3 special conversations. This is Bloomberg.